again, I'm really pleased to be here, and I don't want to bore you with a lot of background, but just to know where we as Aurora and myself come from. As I said, was really happy to have the opportunity to study at Göttingen and also do my PhD there. And very briefly, I worked a few years in a strategy consultancy after that, and then joined Aurora Energy Research about 7 years ago. It was a very small company back then. Now it's about 250 people all across the world with a big focus on Europe. And in essence, what we do is we use economic models to provide advice in the energy market. Advice basically means if someone, for example, buys or sells a wind farm or decides to invest in a battery, then they use long-term forecasts. And one of the major outputs is the power price, because if you buy or sell an asset, you want to know what it's worth, and there the power price plays a big role. So this is one part, but the other is also policy questions, and we like to work on policy questions if there's an answer that is quantifiable, because that's often a very useful angle, we think. And one of the topics that obviously has been quite important in the last 3-4 months was how to deal with the war that Russia launched on the Ukraine, and of course the consequences for the energy sector as a whole. And that's what I want to talk about a little bit today. And what I'm using here is basically we had a big conference that we organized about 3-4 weeks ago in Berlin, and that was one of the keynotes that we gave there. So I think the background politically is pretty obvious for everyone. It's needless to say it's a massive shift in foreign policy and security policy. I just came back from a conference in Sweden. It made Sweden and Finland reconsider their affiliation to NATO. It made Germany reconsider basically decades of appeasement policy against Russia. And I think the interesting part when it comes to energy that energy is very much at the heart of the crisis. I mean, I think for one, the war has quite clearly surfaced the energy dependency that Europe has on Russian fossil fuels, also nuclear fuel, by the way, and gas in particular. And I think this is especially relevant for Germany. Again, here I'm giving background and again, going a bit into the specifics in a second, but about 60% of the imports of gas in Germany were from Russia. That has come down a little bit, but it's basically the neuralgic point, so to speak, that also is a potential divisor or something that can make the Western alliance between EU member states and the US break. And this is also ruthlessly used by Russia. It's used as a pressure point. And it's basically, if you look back a little bit, the strategy of Gazprom or Russia for decades was to show that they are a reliable supplier. Even during the Cold War, there was often talk about that. But if you look at signs just before this war in the Ukraine started, it's actually becoming quite clear that it's now used as a political mean to exert pressure. So, for example, the gas storages in Germany, which have been bought, the ones that haven't been owned by Gazprom before have been bought in the last years. They are very empty, or they were really empty before the war, and no one really considered this as a big thing. But it made the gas crisis and the potential threat to turn off the gas tap to Europe even harder to answer. And we can see this in the very difficult decisions that the German government, Habeck, for example, have to make right now. So that's a big bit of the background. There's more to tell about other fossil fuels like oil. Again, it's not very clear story how the EU responds to that with a part embargo, the full embargo on coal. But I want to focus on gas, because the price rise that we've seen during the start of the war and since then is quite significant and hasn't been seen so far in the last decade. So just to give you a relation, you see it here on the left hand of the chart. A unit of measurement is euro per megawatt, so unit euro per unit of energy, and it has been around 20 euros per megawatt hour, and that before the war, and that rose to about 100 at peak. And then you see also the power price here on the chart, which is of course, both are actually quite important also for industry and consumers. And this is very related to the gas price because it's often gas plants that set the price in the power market. So it's often the marginal unit. And then you look at basically the production cost to produce a unit of power of these marginal units. And there the gas price is a big input. So it's a very strong correlation. And you can see this also here in the chart. So both power prices and gas prices have risen by a factor 4 or 5 compared to what was the normal before the war. And that of course, exerts a lot of political pressure because you need to think about how this affects industry, but also residential and consumers, smaller commerce, etc. So that's a bit of the context. And I think the other important part that we shouldn't lose sight of is beyond this short-term and potentially longer-term crisis of the war, there's of course the very long-term climate crisis that needs to be addressed. And that has been clear for decades again, but the dynamics have actually sped up, especially with the Greens in the government since last year. So already before the war, there was a quite ambitious program that the new government set themselves to speed up the decarbonization of the German economy. And I just want to quickly run you through the main highlights here with a bit of a focus on the power sector. So one of the aims is by 2030, the amount of electricity that is basically produced by renewables, and with that I mean wind and solar majorly, should rise to 80%. We are currently at around about 40%, but also the power demand itself will rise from around about 600 terawatt hours to 750, and that's mainly driven by electrification of industry, of transport, and of heat. There's a big ambition to build electrolyzers. So these are basically facilities to produce hydrogen, which is one of the big hopes to decarbonize industry, where electrification is not a cost-efficient measure, and about 10 gigawatts. And just to put this in relation, the first projects that have been built are a few hundred megawatts. So it's basically 1%, 2% of that, which is in place right now. So that's also very ambitious. Then basically continuing the next years, the idea is really by 2035, so in less than 50 years, to have all power supplied by renewables and all sectors to be climate neutral by 2045. And you see a little bit what that means in terms of the numbers for renewables. We are currently then here on the left bottom, so to speak. We're currently, so now this is energy, not capacity. So capacity is basically how much you can produce at peak, and energy is the energy, and there are lots of physics people here, so I probably don't have to explain the difference. But in terawatt hours on the left bottom, you see we're currently at around about 270 terawatt hours, and the idea is to raise that to 600. So that's quite more than doubling the amount in less than 8 years. And also on the right-hand side, you see per technologies, the main technologies being solar, wind onshore and wind offshore, an increase from 63 gigawatts right now to 215 in 2030. And I won't read out all the other numbers, but we'll come back to this later. It's actually extremely ambitious, and there are quite a few reasons to doubt that the government will be actually able to achieve that. So this is the other important context. Yeah, and now the question basically that I want to discuss today, three. I mean, one is of course what would happen in case that basically the gas stops flowing this or next month, because that's the ultimate threat that is on the table, and which also makes the German government very cautious, partly in their response to the war in Ukraine. Then also, what's the medium term, or what are medium term scenarios for gas supply to Germany? What does it do to prices, and the implications for renewables and hydrogen in Germany? And the reason why I'm focusing here on prices is that, of course, one of the drivers why everyone, including me, is very, very positive about the potential that renewables have is that by now they are without much cheaper than fossil fuels. And so the prices that we see for renewables, but also for power, that makes them actually economic without a big amount of subsidies, is actually quite an important driver. I think the government wouldn't have been that ambitious if there were still the need to pay a lot of subsidies for this amount of renewables. So this is actually quite important context, that the price in relation to the economics of the renewables itself actually makes them a quite attractive, economically attractive source of power supply. Great. Yeah, so the first question basically, and here I'm summing up a lot of work by our teams, is what would happen if basically Russian flows stop? What would happen next winter? And what we see here is basically a breakdown of the gas demand that Germany should expect to have in such a scenario. So this is on the right-hand side, this big gray bar. So we would expect 80 billion cubic meters of gas. That's the unit how you usually measure natural gas. That varies, of course. Cold winter has more demand. So that's the additional 7 there, 87. And then the question is, what of that can be supplied by other sources than Russia if Russian gas is not available? And there's around about 60 BCM from neighboring countries, and that is gas flowing through Netherlands, coming from Norway, for example, gas flowing through Southern Europe, being supplied by Algeria, for example, or from the southeast through a pipeline that connects Italy through Turkey. And that covers some of it, but not all of it. There's a little bit of domestic production in Germany, but not a lot. And there's limited potential to ramp this up. This is the 6 BCM in the second yellow bar there. Gas storage utilization, that's an important factor. So you need to fill your storages to come over the winter. But because we actually look here at a full year, so basically from when we did this analysis, April to March next year, there's little potential to use a lot of storage over this duration, because the storages were quite empty at the start of this period. There are a few levers that probably will happen anyways in terms of gas demand reduction. That is mainly around behavioral changes and turning down your thermostat in such a crisis. There are factors in the power sector. These are the 4 BCM there, which basically involve more coal, which is counterintuitive, but this is likely, so this is happening economically because gas plants are now more expensive than coal plants. So in the basically market mechanism, it's more profitable to run coal plants. But there are also basically plans in the drawer of the government to revive coal plants that have been put in various reserves in Germany to meet climate targets if such a crisis scenario hits, and this is also included there. There's fuel substitution in industry. There's a little bit, so gas is not just used for energy, but also as feedstock, for example. But there's little room to substitute that. But the reason why this is actually such a critical topic is that the remainder will hit industry. I mean, there's European legislation that puts consumers first, so there's no mechanism that any government can actually force residential consumers to turn down their gas consumption. So the first ones that would be hit are industrial consumers. And Germany is obviously a very industry-heavy economy, and sectors like metal, automotive, and chemicals would be hit quite directly. What we did then is basically an analysis to look at, it's actually a very complicated topic because every production facility is different. There are dependencies in the supply chain, etc. But we did a first analysis to look at how much of industry demand would have to be curtailed and at what gas price by looking at European-wide economic data, basically the cross domestic product that's generated per sector. And then and this is like this box, the call out that you see on the right top, and then compare that to the energy use in terms of gas and in terms of power, and the prices last year when this cross domestic production was measured. And then we basically looked at how high does the gas price and in turn also the power price have to be in order for the energy cost to be equal to their value add in the whole economy, because that's a good approximation of when energy prices would actually be so high that they would stop producing. And what we see here is that in Germany, so the uncertainty here from 4 to 7 BCM of industry gas demand curtailment coming from the uncertainty in the overall demand with a cold on average winter, the gas prices at which this curtailment would happen to get like 4 to 11 BCM of savings would be around 200 to 260 euros per megawatt hour. And that gives you a sense of where the current gas prices come from. So usually, as an energy economist, you look at the production cost of an energy good, but currently it's basically the curtailment of demand that sets this price. And this is it's a quite high price, but it's not an unreasonable price. So it's not necessarily speculation. This is happening right now. So steel producers, chemical companies are turning down their production because they can't bear the cost. And that's basically the dilemma that the German government faces, and why someone like Habeck invests a lot of time, I guess, and energy into explaining this, but not joining a gas embargo against Russia, because the economic impact of that is potentially large. Great, so that's the short-term impact in very brief words. Longer term, the interesting point is that Germany can actually get independent of Russian gas, we think, within the next 4 to 5 years. And the main mean by which to achieve that is LNG, so liquefied natural gas. I'm sure you've heard it. It's basically gas that's under high pressure, put in liquid form. You can put it in a tanker, you can ship it all across the world, and then you need terminals basically to gasify it again. And these terminals are actually the bottleneck. So there are not enough terminals in Germany to get enough liquefied natural gas into the country to replace all the Russian imports, which came by pipeline. There are big plans to build terminals, and the fastest way to do so is actually to use ships where there are pre-installed terminals, and there are quite a few around the world, 30, 40. And the German government currently said that they secured 3 of them, one certainly coming for next winter, and then other 2 for the winter after that, so 2023, 2024. And they also plans to build long-term terminals, so that by 2024, 2025, we'll have enough import capacity to actually supply the gas that Germany needs on average via LNG, which then mainly will come from the US. That will come with higher prices because, I mean, the main reason why Germany had this stance toward Russian gas imports is because it was very cheap. So Russian gas, here you see the LNG cost, but just for comparison, Russian gas in terms of production and transportation costs is between 10 and 13 euros per megawatt hour. And this compares to around about 30 to or 35 to 50 euros per megawatt hour for LNG, because you have transport cost and also you need to build infrastructure to get this gas exported to Germany, and this is costly. And the suppliers, mainly in the US, will want to have long-term contracts that partly cover that investment in this fixed cost. This is the big bucket here, the 40 euros per megawatt hour in this bar in the middle. So it's possible. It will be more costly. And this is shown by our modeling, but also by basically the market expectations. So the purple line, somewhat purple line here is what our modeling shows. The gray line is the contracts that you can secure on the market for a gas delivery in 2024, 2025, which are all around about this mark of 40 euro per megawatt hour. That's one scenario. So basically Germany, and this is the plan on an EU level, and also the announcement from government, gets independent of Russian gas by building these LNG terminal. The other potential scenario is actually, it sounds a bit cynical, but return back to normal. Basically, we call it a continued flow scenario. What you here see on the right-hand side is the transport routes, how Russian gas actually flew and still flows into Germany. This is Nord Stream. You all heard about that. There's Nord Stream 1, which is in place since years, and there's Nord Stream 2, which has been canceled, and we don't think that it will ever come back. But Nord Stream 1 is basically was fully utilized until a few days ago. And then there's some maintenance issues at the moment. There's Jamal, which basically goes through Poland and supplies gas to Germany. And there's a corridor through the Ukraine, so-called Brotherhood pipeline. And they're all still flowing and supplying gas to Germany. And one of the again, it may sound cynical, but one of the questions is like, if the gas is still flowing during the war, there's no embargo, it's so much cheaper. If the attention span then basically turns to the next thing, I mean, is it really politically so high on the agenda that you will turn off the tap, which is why we want to contrast it by a scenario here, which basically assumes no Nord Stream 2, but still continued flow through these main import routes. And that gives you a gas price of around about 20 to 25 euros, which you can see here in the blue line. So these are basically the potential scenarios. And as always, there's a continuum between these, and we make things more simple by putting out two discrete worlds here. But these are the main uncertainties and potential scenarios around that on the gas side. Now, what does it mean for the transformation of the German energy sector? That means in terms of decarbonization, the power sector needs to do the heavy lifting, at least for the next decade. We contrasted this then now by basically two power market scenarios, and this is basically here on the horizontal axis. So the green one, the ambitious decarbonization, that basically reflects what would happen if the government would be able to achieve their target. So we talked about the big ambitions in building out renewable capacity. It would lead to a lot of rising demand, so in total 750 terawatt hours. And here we pointed out the one component in electric heating, which is quite big, and lots of hydrogen. And then we contrasted that also by basically the a scenario that is still ambitious but more moderate because of the issues that renewables built out face. And these are grid extension is a big one, very long permitting processes for renewables, in particular onshore wind, potentially solar also in the future, and bottlenecks in the supply chain. I will talk a little bit about that in one of the coming slides. But it's basically to contrast what the government wants to achieve with something that is still ambitious, but more realistic in our view, as much as I personally would like these targets to be achieved, unfortunately. So then with these two scenarios, we ran through basically what it would take in terms of renewables build out and also then later prices to achieve that. And just to double down on the first point a little bit, we've seen the big capacity build out, but another way to look at it here is the yearly gross build out of renewables that would be required to achieve that target. So again, on the left-hand side, you see numbers that you've seen before. It's like the total renewable capacity now, and then the total renewable capacity in the target scenario, 360 gigawatts, and what we see in a more moderate, still ambitious build out, which we call a central scenario. But then if you look at the annual gross build out, solar, for example, so the 10-year average over the last years was 4 gigawatts per year. If you would like to achieve the target, you would have to build around about 18 gigawatts. So that's like 4.4 times more than ever has been achieved, or on average has been achieved in the past. And still central, like the moderate build out, is more than 2 times a faster build out. Similar like increase in speed, so to speak, also for onshore and offshore, albeit at a bit lower rate. So that exemplifies like what a big shift that would be in order to reach the targets that are set out on the agenda. And then again, power demand comes in a similar direction, although that's rather a percent increase, not a times X factor, but still 30% increase in power demand is a big one to stem, with quite a few challenges coming with it. Now, I mentioned it quickly at the beginning, and one of the reasons why many people, so not just the government, also renewables developers and investors, banks with whom we work a lot, are so positive about renewables is actually they don't need subsidies anymore. If you build an offshore farm, you deliver so-called zero bits. So you say in a subsidy auction mechanism, you have to say how much subsidies you want to get from the government and ultimately the citizens to build your offshore farm. And all the bits are zero because people see power prices that are high enough to recover all the cost, big investment cost, but some fixed cost for these assets over the lifetime of the asset. So you don't need support anymore. And this is also one of the reasons why people are so positive about renewables. And this is quite interesting because the power price plays a big role. And I do a little bit of a a side detour here to explain what I'm going to show next. The power price is important, but what makes renewables special is they are intermittent. So that means you can't influence when they are producing, right? I mean, solar panels are producing when the sun is shining, and vice versa for wind blowing for wind turbines. And that means if one solar panel produces, all solar panels produce a very highly correlated production. And that means on average, when they produce, there's a lot of supply on the market. And that means that on average prices are lower with lots of renewables in the market, right? In the very hour, like when solar produces, everyone else produces as well. And that means you don't get a lot for the power you sell. The more solar you build, the higher this, you could call it cannibalization effect of price. And this is actually the price that then determines whether someone builds a solar farm or a wind farm without subsidies or not. We call it the capture price. And one of the important questions, if you think about the need for subsidies going forward, is what is this capture price? So are economics actually a barrier for this ambitious renewables build out in the future? And there are two ways to look at it. I mean, one is we model these market scenarios with these two gas price uncertainties and the two uncertainties around renewables build out, and going into this in a second. But also long term, there's an interesting question, like in a market where you basically almost only have renewables, what does set the price? Is there still a meaningful price for renewables? Because renewables basically have very little marginal cost. You don't need to burn a fuel to produce the power, and you don't need to buy carbon certificates, so to speak, to produce your power. So there's no, the economists would say, variable cost to production. And that means, like, even if the price is very low, you would still continue to produce. So on the first question, the capture prices we did, or the modeling behind that, and what you see here on the, and really happy to jump into details in the Q&A later on, but just to give you the main implications here. So what you see here on the chart is first the capture prices for these renewables, so what they would receive in the market in 2030, actually, in these different scenarios. The scenarios are, we call it central, more moderate renewables build out. Target is if the government achieves everything, and then with two scenarios on the gas prices, so continued flow and this switch to LNG scenarios. It's basically a 2x2 matrix, and then you run through all scenarios and all capture prices. Then we contrast that with the so-called levelized cost of electricity. So that is basically a measure of how much it costs to produce the power if you include the investments at the start of building the asset, the fixed cost that you have, and the variable cost. So, and the short point being here, as long as capture price is above your lifetime cost of producing the electricity, it makes sense to build this without subsidies. So as long as the capture price is above LCOE, renewables don't need subsidies. And this is what was observable basically in the market. And the interesting point here is actually for wind, it looks really good. Even in such an ambitious build out where you would expect a lot of cannibalization, we see that in most scenarios, actually the capture prices are above the levelized cost of electricity. And more interestingly, a switch to LNG and a turning away from Russian gas, which makes gas more expensive and thereby power more expensive, actually makes these quite profitable investments. So a shift away from Russian gas would actually help renewables build out. This story is a little bit different for solar, because solar has, you call it the load factor, basically how much power is produced. It has a much more correlated production profile than wind. So wind produces in 30 to 50% of the hours of a year, solar farm only 10% of the hours. And that means this cannibalization effect is higher. And also the government has much higher targets on solar build out. And that means in scenarios where you don't have shift away from Russian gas and high targets, so that's basically continued flow here and target, you see a big gap. And this is actually meaning that you would need to return to quite a few subsidies to be paid for solar in order to reach these targets. So yeah, the summary basically being wind is fine and solar is very dependent on the economic conditions, and especially how the future of gas supply to Germany and Europe as a whole turns out. then the other point was, that's a slightly complicated chart here, but the other question we often get from people who do invest quite a bit of time and sometimes also a lot of money into the energy market is like, if everything is supplied by renewables and they basically have zero marginal costs, so why don't prices just crash? Is it a stupid idea to build a wind farm now that will last for 30, 35 years with the belief that we will have all renewable power supply maybe in or hopefully in already 15 years, and nothing meaningful basically setting the price, and then basically I lose all my money and have stranded investments on the renewable side. And the really interesting part is that we played this through. What you see here is basically all the hours in a year in our price simulations. And then you take away all the conventional fuels, but you need to replace it by something that provides flexibility when the wind is not blowing and the sun is not shining. And this can be partly covered by storage, batteries. To put a long story short, batteries are not enough. They're good to store energy over 4 or 8 hours, but you have cycles in the renewables production which are much longer. So for example, the frequency in high and low wind periods are rather like 3-4 days. And for that, the most viable economic solution is actually have plants that burn hydrogen to produce power. So like a gas plant just running on hydrogen. And the interesting point is, if you just have a few of these and you don't need a lot, so basically the overall power supply that we see by these hydrogen plants in a completely decarbonized power sector is around about 10%. The rest can be done by other flexibility and trading across markets and renewables. They still set the price for quite a few hours. And this is what you see here on the purple chart. And that means these are the hours where renewables earn their money. So it's not when the wind is blowing strongest or the sun is shining. It's rather on a cloudy day or on a low wind day when something else is needed to produce a marginal unit of power, and actually sets the price. And you can do all the numbers, but what comes out is actually that there's a strong case also for subsidy-free renewables, even in a completely decarbonized power market. So the summary here is that economics are not the problem to build renewables en large, even with the huge amounts that we need and want to put in the system. But there are quite a few challenges, and I just want to point out 3 things here. It's around the supply chain, it's about grid extension, and it's about permitting and consenting. So on the supply chain, there are many topics to mention, but one is certainly the rising price and inflation environment. You see it with raw materials that are used for renewables. So steel for wind, polysilicon for solar cells, for example. Labor is a big factor, and basically also just the duration that is needed to secure critical parts. So the lead times to realize a project have gone up quite significantly over the last year. The other interesting point on the supply chain, I personally think, is we always talk about dependency from Russia. If you look at the share of solar panels, you see it here on the lower left, that is supplied to all of Europe by China. It's 3/4. And this is because they are much more cost effective than Europe. And so basically, you could make the argument, and because it's not as acute and critical as with the war on the Ukraine, but that we're walking from one dependency into another one. Because basically the German solar panel industry, except for one firm, is dead in Germany. And that creates another political dependency that might be leveraged by China in the future. So this is also why there's a big shift to revive the German or the European solar industry, and Habeck is supporting that. But it will take a decade basically to build this up. So this is one challenge. The other one is grid extension. So what I just put here on the chart is basically, we saw the number of gigawatts of renewables that are planned to be in the grid by 2030, 360. And then if you look at the latest plan by the grid regulator, the Bundesnetzagentur, the most ambitious scenario has 5 years later 245 of renewables, gigawatts of renewables in their grid planning. And even against this plan, we already see delays. And that indicates how difficult it will be, not just to get the solar farms and the wind farms online, but actually to build the grid that can absorb all the power. So that's the second challenge. And the third one is permitting. sorry, I jumped too quickly. It's permitting and consenting. So it's basically to even get enough windmills allowed. And one critical point here is often to get a permit, there's a certain period where people can actually raise concerns, and it's often about animal protection, birds, or other concerns with sound or sight. And this basically led to a point where the amount of capacity that is auctioned every year for wind onshore, this is what's shown here on the right-hand side, even in a less ambitious pathway, which is just 3 to 4 gigawatts per year, has not even been filled. So there were auctions where basically the regulator told the project developers, you basically get all the money you need, just tell us how much in subsidies if you build a wind farm. And there were not enough wind farm projects that were able to be built because of these permitting issues to fill these targets. And now these targets are being raised by a factor 2.5. So this is another issue, and there are plans to address that. So the recent Easter package of the government basically put quite a lot of emphasis on pushing these projects through, even against resistance of locals. This is in the end what it means, and also forces the states in Germany to dedicate areas to build these wind farms. But it's still a massively complex task, because you need to align not just on the federal level, you also need to align with the states and the individual communities and the individuals who actually live next to these projects. So these are the challenges out there. And then a last point maybe to make on, to return back to gas. So actually we think that, there are good reasons to get rid of the gas dependency. But paradoxically, in the power sector, you will need gas, at least over the next decade, because the hydrogen that is being ramped up will be needed first in industry. It's basically chemical industry, partly cement, steel. They all need hydrogen to decarbonize. They have no other option. And it's much more expensive to actually produce hydrogen at a efficiency of around about 50%, and then burn it again at an efficiency of 50% to then again produce power, than just using it in industry. So you will first need it in industry, which means gas still needs to be there as a bridging technology. So, and that actually in all these scenarios, that's what we see here on the left-hand side, the demand for natural gas in the power sector is actually rising over the next 8 years. So hydrogen will play a big role, but it will first be used in industry and only later in power. Great. Let me stop here. There's lots of topics that I only briefly touched. So thanks, and I hope we can still have a good Q&A and discussion for the remaining 50 minutes.